This is Macro Watch, first quarter 2014. The analysis presented in these videos is based on my belief that in this new age of fiat money, credit growth drives economic growth. Liquidity determines the direction of asset prices, and the government attempts to control both credit growth and liquidity to ensure that the economy continues to grow. Therefore, Macro Watch analyzes trends in credit growth, liquidity, and government policy in order to anticipate the impact they will have on economic growth and asset prices. This issue of Macro Watch has 5 videos. The first is an economic overview. Here we'll look at some of the key economic indicators to see how much strength the US economy really has. We'll also consider how the economy has been affected by the surge in household sector net worth that's come about as a result of quantitative easing. At $77 trillion, net worth is now up $21 trillion from its post-crisis low and is 12% above its pre-crisis peak. In the second video, we'll consider whether credit growth is likely to accelerate. Credit growth remains weak, but there is some momentum building in mortgage debt. What we'll try to determine here is whether this momentum in mortgage debt is going to accelerate enough to begin to drive economic growth. Then in the third video, we'll look at the Fed and liquidity. Now that the Fed has begun to taper its pace of fiat money creation, we'll consider how the Fed's taper schedule will impact liquidity. And we'll use a liquidity gauge to determine if there will be excess liquidity or a liquidity drain over the next couple of years. In the fourth video, we'll look at liquidity on a quarterly basis for 2014 and consider how it's likely to impact asset prices from one quarter to the next. During the first half of the year, excess liquidity should persist and continue to support asset prices. But during the second half, liquidity will dry up. At that point, the Fed's likely to extend quantitative easing. If it doesn't, the economy and asset prices are likely to suffer. Finally, we'll look at the risk of global deflation. Here we'll look at economic conditions and policy in the United States, Japan, the UK, the Eurozone, and China. And we'll consider the factors affecting aggregate demand in each of those economies: fiscal policy, monetary policy, and credit growth. We'll see that ending quantitative easing would greatly increase the chances of global deflation.